If again the definition or purpose of a benchmark is for it to be a reasonable investment, no one would ever say that a portfolio with 41% invested in 10 companies at valuations that are significantly higher than the tech bubble, if you look at forward PEs, is a reasonable investment. So therefore, it's a terrible benchmark.
We're back. It's episode 6 of Building Better Portfolios. I'm Paisley Nardini, joined by my co-host Josh Flade, and I'm personally very excited for today's guest, which is Seth Cogswell. Seth and I have gotten to know each other over the last couple months. We spent some time together. I've traveled out to Minnesota, where I'm from and where Seth lives. We've gotten to hit the golf course and realize we're both not very great at golf. No offense, Seth, but he's better at investing. Maybe not as great as golf. But he has
I
fun.
think I'm a little better than you are at golf too.
I won't disagree with that. The bar is low.
I won't kick you while you're down.
It's good to know your strengths and weaknesses.
Exactly. So Seth, thanks for joining us. Seth is the founder of Running Oak Capital. He is the portfolio manager of their efficient growth strategy. And we wanted to bring Seth on today, not because he's a great individual, but I think they're doing something really unique. In a sea of passive markets and a sea of market cap weighting within equities, Seth and his team are really looking at how can you fill this gap within your portfolio? How can you find sources of long-term growth and maybe some more upside than maybe some of these passive markets are giving us? So again, Seth, super excited that you're joining us. I would love to start out with something that's super unique is when you think about a lot of strategies in the marketplace and you talk about track records and history of these strategies, oftentimes we're excited to hit a 3-year, maybe we have a 5-year, and if you have a 10-year track record, it's like, wow, you guys have been around for a while. Seth and his team have a very lengthy track record. They've been doing this for decades. And so maybe we start there, Seth, by just giving us a little bit of history of kind of the foundation of the firm and your philosophy and kind of what led to the launch of this company. I guess a little over a decade ago now.
That's definitely an asset that I had going for me when I launched it. I was fortunate not to start from scratch. We're not going to talk ticker at the moment, but we launched an ETF a couple of years ago. And so I actually get this question really often because that ETF's grown faster than supposedly just about any. It's been one of the better launches. I don't know if it's true that it was necessarily one of the best launches for a boutique firm, but it sounds really nice. So I repeat it and tell myself that as I go to sleep at night.
I actually agree. Like being in the ETF business myself, where you guys have gotten to in a very short period of time with the fact that there's massive headwinds right now because most people are just relegating to passive. So the fact that you're doing something unique and you guys have continued to grow meaningfully, I think you guys definitely stick out.
Yeah, and that was driven by two things. So the big one, which you already mentioned, is just simply, yes, we launched the ETF 2 years ago, but there's nothing new about it. Actively managed ETFs in general is a pretty new dynamic in the market, and many of them have new strategies that go along with it. Whereas for us, yes, the ETF's 2 years old, but we have a 12-year audited track record for the strategy. We actually have 36 years of real-time data, and some of which I actually managed before I started the company as well, and then a 5-decade history. So the strategy is actually older than I am. There probably aren't many managers you talk to where the strategy is older than they are, but my father created it. So you can kind of say that I was on this path pre-womb, maybe even before I was even considered as a being. But my father started out at a big bank doing what all analysts do at big banks, which is basically discounted cash flow models trying to kind of predict the future, which if you think of a multinational company, that means you're trying to predict products before they exist, the revenues of those non-existent products into decades into the future, and then you're discounting it back at some number. And some people do it really well. It's a little easier with real estate. He felt that just was not an area where he had an edge, and so he decided to go a completely different direction, focused on what's known versus unknown. So focus on 3 very simple, common sense principles that no one will ever be able to convince me won't provide value over the long run, whether it's higher return, lower risk. And so those are maximize earnings growth, because generally speaking, everyone knows that nothing drives price performance like earnings growth for the very obvious reason that if you invest in a company that's growing in value, that's not going to be a bad thing. Now, the issue is, and we see it a lot today, is the company and the stock price, generally speaking, are related, but sometimes it becomes untethered. I would argue today might be that, that might be the case. But valuations really matter. So as great as it is to invest in a company that's growing in value, you also needs to be rooted in reality and the price that you're paying for it. Many studies show that managers, for the most part, do a great job selecting companies. They do a good job timing their buys. Where they really struggle is selling. And the reason is selling is an emotional decision. If you pick a company or pick a stock and it kills it, you become attached to it, right? You think of it fondly when you go to bed at night, and then having to part with it is painful. And you also don't want to tell your clients that you're going to have to pay taxes. Luckily, with our process, which is rules-based, it's designed specifically to be unemotional and repeatable. It takes that emotion out of the equation for us. So when a company hits a point where we feel it should go down, we sell. And particularly in the ETF structure, there's no tax implications, which is nice, because that's another issue for many, is it's just not fun to tell clients that you have to pay taxes, and nobody wants to pay taxes. Why that matters so much right now, I mean, you mentioned just sort of the environment, is it's a pretty wild time. I think whether it's life or the markets, things feel pretty uncertain, particularly a little excitable, especially in the market, given valuations. Our goal is to really maximize that cumulative growth or that exponential growth over the long run for our clients. And there's two very distinct ways to do that. One is to push that exponential growth rate up, which is what we seek to do with that focus on earnings growth, right? Invest in companies that are growing as fast as possible, but nothing destroys exponential growth like big drawdowns. The very obvious example that pretty much every advisor is probably share with clients is you drop 50%, you have to double your money to get back to flat. You drop 30, which isn't fun. You only need a 40% return versus 100 to be making new highs. And so that's also a big focus of ours and kind of our third principle. So it's really maximize earnings growth, discipline around valuations, lower downside risk. And again, that process is rules-based, makes it very repeatable, which is why, going back to the history, it has effectively stood the test of time over 5 decades. It really hasn't changed much. And I'd argue that, generally speaking, the best answer to life's most complicated questions is the simplest. People currently think that it's really easy to invest in the stock market. In fact, I think Robinhood CEO recently, in response to AI and people potentially losing jobs, I'm pretty sure he made a comment that maybe people will be able to just trade on their own with the help of AI and just make money. I don't know. That's completely contrary to my experience. I was a trader. It's really hard. And at some point, there was a number where it was like 99% of those who trade don't make money. So it's hard to make money, generally speaking. Seems a little easy at the moment. But again, that common sense nature of our philosophy, and then that kind of disciplined process is really what's enabled it to perform so well for so long. In particular, I mean, what led to me going down this route is in 2012, 2013, I went to business school to see if it made sense to effectively mortgage my family's future to go down this path. And we had real-time data from 89 to 2012, 2013. And I had participated in creating part of that or generating part of that. I had also watched the entirety of the creation. And over that 23, 24-year period, it outperformed the S&P by about 3.5%, which was top 1 percentile returns or so. Great. But much more importantly to me, coming from a P&L background where I had lost 2 years worth of New York City rent a few times in seconds. Luckily, my best days were better than my worst. But I was very concerned about downside risk. And the strategy, whether from today all the way back to has effectively provided less than half of the average drawdown of the S&P. And so that just led me to conclude it was way too good to not start. Started the company with a whopping $800,000 under management because I unfortunately didn't really know anybody with money. 3 of my professors from business school were actually our first clients, which was cool. And as of now, we're up to right under $1 billion as a firm.
And totally across SMA, ETF, any other vehicles? Yeah, okay.
Total is right around $1 billion.
Yeah, which is super impressive given how lean your firm is.
Yeah, but yes. Well, sure. Thank you. I like to think that I'm high powered, No, it's a quantitative strategy. And so for a quantitative strategy or rules-based strategy, the real work is done at the outset. So it's creating the strategy, creating the process, creating whatever tools you need to make it happen. Whereas a more fundamental strategy might change day by day and is more dependent on what you find, the people that are part of the firm. So that certainly enabled us to be fairly lean.
Yeah. So one thing I want to dive into is the strategy itself. And I'm going to start, I'll just kind of pepper you with some questions, but
Love it.
taking it from the top, what's your preferred benchmark? Because I know there's a couple different ways that you assess, whether it be mid-cap, equal weight, S&P 500. What is the true benchmark, and what are some other ways that you're assessing? And what's the universe of the securities that you're selecting from?
This is a little bit of a trigger question for me, just a heads up, just in case I get a little aggravated. Benchmarks, we don't benchmark. Our goal, the strategy was created to provide the best, let's say, risk-adjusted return or cumulative growth for clients that we feel is within our capacity, right? So one of the cool things about markets in general is there's an infinite number of decisions you can make any day. Some of them will provide value, some of them won't. And we don't feel that we're the way that we do it is the only way to provide value. And I don't even know if I'd say it's the best, although within the equity market, I certainly feel like it's one of the best. But again, the strategy is benchmark agnostic for the most part. Now, the purpose of a benchmark that I feel many kind of miss is it's more for the person who's making the choice to invest, right? A benchmark should be a reasonable investment that you find attractive. And then you use that for a basis of comparison, right? So if you look at other strategies, if something's better, great, right? Now, one thing that bothers me at the moment is, and I hear this a lot from advisors, I feel for them, is the degree to which almost everybody uses the S&P 500 as a benchmark. If again, the definition or purpose of a benchmark is for it to be a reasonable investment, no one would ever say that a portfolio with 41% invested in 10 companies at valuations that are significantly higher than the tech bubble, if you look at forward PEs, is a reasonable investment. So therefore, it's a terrible benchmark. Now, for us specifically, if I'm going to help people analyze our strategy, I would use the S&P 500 equal weight because our portfolio is equally weighted. The universe is pretty similar. It's a little bit bigger, so it goes a little bit more into mid-cap. So you could use the Russell mid-cap as a benchmark potentially because we are mid-cappy. But really, if we want to get cute, it's probably a blend of the S&P equal weight and then the Russell mid-cap.
Okay, and I think Morningstar classifies you as mid-core, which, whether or not you fully agree with that, I know a lot.
I actually agree with that. I don't agree with everything Morningstar does or much, but I do agree with that.
So then, as it relates to some of the screening that you're doing, so again, this is quantitative, systematic, rules-based, and you talked about seeking earnings growth, thinking through a valuation lens, without giving away the IP. What are some of those common factors and attributes, I would say, of companies that you guys are assessing when you're putting securities into the portfolio?
Our goal is to find the intersection of companies that are growing at a high rate, obviously as high as possible, but within the constraints of being attractively valued in lower downside risk in certain ways. One of the main ways as far as downside risk goes is a focus on debt for the very obvious reason that we all know if we max out our credit cards, we're headed for a world of hurt. Another thing that's been a little bit of a source of annoyance recently is we favor lower beta, less volatile companies. And in the last 5 months, low volatility was the absolute worst performing factor out of, I think, 223 on Bloomberg. So so again, it's really just, we want to find as good a companies as possible that are, where they have room to run. And that means that historically, the average earnings growth rate of the portfolio has been around 12 to 13% versus 6 to 7 for the S&P. So it's a pretty big gap that we would expect to provide value, right? I mean, that 6 to 7% is a portfolio that's creating more wealth for its shareholders. Ideally, if you're investing in undervalued companies, then that creates also that potential for upside. In particular, again, the thing that I focus on most is actually avoiding overvalued companies. That's probably far more important than investing in undervalued companies, because you really want to avoid that mean reversion when things go back to normal or go back to where they should be. And it's kind of like Warren Buffett, when he got started in the business, he was very focused on deep value, a little more kind of Benjamin Graham style. And it was Charlie Munger that got him to really focus on, instead of good companies at great prices, he got Warren Buffett to focus on great companies at good prices. And that kind of describes what we do perfectly, is just looking for really good, well-run companies with strong balance sheets that are growing at a high rate that we can get at a good value.
And so how can advisors think about this within their portfolio? I know that you're kind of benchmark agnostic, but if I'm an advisor, I probably have some kind of policy statement where I have large cap, mid cap, et cetera. What are you vying for in an advisor's portfolio?
Hopefully they have mid cap. I've found recently that very few have mid cap at all. They kind of go from large to small. But our portfolio, because of that rules-based, very disciplined nature, it consistently sits in the same spot. I actually had an advisor a few weeks ago say that when they hire a manager, they just want them to do their job. They don't need them to do everything. They don't need them to be the best large cap growth manager and the best small cap value manager. Them to do what they have been hired to do. And that's the beauty of the rules, is that we consistently do the same thing over and over, which we've basically done for 5 decades, which results in a very consistent result, which sits in that mid-large core space. Our minimum market cap is $5 billion, and then we invest above that. And then the portfolio is growthy because we want to maximize earnings growth, but that focus on valuations and risk brings it back into core. And so that's really where it's meant to be used. And that's where our longest clients use us. We help clients and a number of platforms with model construction, at least our oldest clients, and we use it in the same way, which is as that sort of mid-large core holding, which happens to be a space where people own almost none of. So it's, at the very least, it's a really good complement to what people own the most of. So whether it's large cap growth, small, over to value, we sit right in the middle in a pocket that people own very little of. But also it's a diversified, risk-focused, disciplined strategy that sits right in the middle of your portfolio. And again, over the last 36 years, it's had probably top half or top 1 percentile risk-adjusted return. And so it's really meant to be sort of that steady kind of rock in the center of your portfolio.
Seth, how many stocks typically are in the portfolio? And then how do you think about kind of sell discipline? And how does that work within kind of your quant-driven model?
So the range is 50 to 75. Right now we have 54. Usually it's in the mid-60s. As far as the sell discipline goes, there's 2 reasons why we generally sell. And the first is we're right and it works out. And so when a company hits a point that's 15% beyond the fair value that we've determined, we sell. At that point, we would much rather own a company that should go up than should go down. The other reason why we sell is we're not right, and a company comes out and warns no longer meets our rules, particularly our earnings growth criteria, and for that reason will also sell. Those are really kind of the two major reasons, but there's a few others, such as, again, I mentioned debt earlier. There were a couple companies, especially in the last decade. In the last decade, companies took on more debt than any time in history. And in the past, when a company did so, they would invest in the company and ideally do so to create greater cash flows so that they could service that interest, pay down the principal, and then generate profit on top of it. In the last decade, companies did not do that. They largely just bought back stock. And what you saw in a handful of names was they took on so much debt and bought so much stock that they ended up having negative book values, which Benjamin Graham probably never even fathomed was a possibility. I don't know. But it's pretty wild. And so for that reason, there were a small number of really good companies that just blew through our debt max, let's say our debt limits, and we had to sell.
So maybe in the last 10 minutes here, we can shift to start to talk a little bit about markets. I know you have some thoughts. You and I had a discussion recently on passive and your thoughts around that. A phrase that I'm trying to make happen is make investing active again. And I think that as it relates to anything beyond just market cap weighted, I view that as active, whether it's smart beta, quant driven, fundamental, stock picking, but also active through the lens of the allocator. I think a lot of advisors, as well as massive global pensions, have just fully relegated to passive, and they minimize their tracking error, and they could care less because they know that, it's like a CYA. I'm not going to have to report to the board because I'm not taking any tracking error. So it's going to be thumbs up. If markets are down, we're down. If markets are up, we're up. And I know you have thoughts on how both allocators and portfolio managers can be a little bit more thoughtful in how they're constructing their portfolios and their investment strategies. So as it relates to the backdrop that we face today with this rise of passive and you looking to stand out and doing something unique and different and kind of dislocating from that, keep buying as things get more and more expensive and keep selling as things get cheaper and cheaper. What are your thoughts around that? How do you position that when you're talking to clients about your strategy?
This is something I'm constantly pondering. It's really funny that you mentioned make investing active again because...
Did somebody already trademark it?
No, but at 2 a.m, I mentioned this was going to be one of the things that that's many might not know about me, which would be really hard to know because it happened at 2 a.m. today. But 2 a.m, all of a sudden I feel like my eyes just sort of popped open, and I was like, it just make America capitalist again. That was
So you and I are on the same wavelength.
We are on the same wavelength, although there's a reason why those two phrases are similar. But I immediately I laid in bed for an hour and just pondered it, and then I grabbed my phone and I checked to see if it was taken, and it wasn't. And so I ran downstairs at 3:30 in the morning and bought the makeamericacapitalistagain.org. I was really excited about it, and then I created.
Everybody go check it out.
There's nothing there at the moment,
Okay.
and this was at 4 a.m, right? I even created a T-shirt, which is in my style.
Yeah.
And then my wife came down at 6:30. I was like, "You won't believe what I just did," and she was like, "I don't know what you're doing. You're out of control. Don't get shot." And I'm like, "It's not a political statement." But all that said, this is something that I do think about a lot, and my philosophy is constantly evolving, and I feel like I've had a recent breakthrough to a certain extent. So I've always been anti-passive in a way because I've been combating being a perfectionist for my whole life. So to be average, to accept being average just is completely against my nature. Regardless of what the numbers are, to just be okay with not thinking and invest in a way that was created 75-ish years ago and wasn't even meant to be a strategy, I could never get around that. Then as time went along, I started thinking more and more about sort of the overall kind of dynamic around this, which is don't think. What major decision in our lives is it best to not think?
You're bungee jumping?
Maybe I don't know if that's a major decision though,
It
but
would be for me.
well, and so for that reason also, I've been sort of averse to it, but it wasn't until really recently where it kind of crystallized, where I thought about it, and it's such a simple concept, but if you think about it on an individual stock basis, let's say at some point you have two companies that are at some point are priced efficiently and equally, right? So they have the same allocation within the S&P. And then one of them, for whatever reason, with nothing changing, appreciates 100, well, let's say 100%. The other one drops 50%, right? Nothing's necessarily changed. Let's say fundamentally these are correct. You're going to invest 4 times as much in the one that's priced 2x what it's worth than you are the one that's 50% off, right? So the cheaper and cheaper, the more undervalued a company gets, the less and less you invest in it. And then the more overvalued a company gets, the more and more you invest in it. It's the exact opposite of buy low, sell high, which we have all said facetiously probably 8,000 times when we're like, this is how you invest, buy low, sell high, because it's obvious. But yet, if you really think about passive portfolio construction, it's the opposite. And then you extrapolate that over 15 years. Again, if you really think about just sort of that construction, that dynamic, the more a company becomes overvalued, the more is invested in it. That as that money comes in, that demand pushes it higher. So now the next person that comes in invests more, and you get this flywheel effect to the point where now we have 41% invested in 10 companies, and those valuations their forward PEs are 20 to 30% beyond the tech bubble. The issue is, what do you do about that? Everybody has these small number of holdings. Recently saw a number that individual households or households on average have about 30% more invested in stocks than they did at the peak of the tech bubble. 55% of equity investment is now in passive. Again, it's probably worth repeating. 41% of passive is invested in just 10 companies. Some of those are pretty highly correlated. And then those 10 companies are trading at a PE beyond the tech bubble. You add to that, the only way for large cap growth to keep up was to be just as crazy, right? So if we go back to the benchmark comment, large cap growth was probably benchmarking against the S&P, and the only way to beat it was to have more concentration. The other issue is anybody that owns individual companies probably owns those same companies too. So the risk or the issue is much greater than I think people fully comprehend. And our portfolio is an excellent counterbalance, right? We believe in buy low, sell high, right? We're looking for undervalued companies because our portfolio is equally weighted. As long as a company meets our criteria, if it declines, we actually add to it to bring it back to equal weighting, which means we're buying low. Not only are we investing in companies we feel are cheap, we're also buying lower. And then when a company gets to a point where we feel it should go down, we sell high. So again, it's a really good complement. But another thing to think about is I have spoken with more and more of the largest platforms. I've gotten a really good sense of how many invest. And almost every platform that I talk to starts out with large cap growth, because if you didn't, you got fired, because that was the only way to keep up. Then they take a barbell approach and balance that with small cap. They completely skip over mid cap.
Yep.
There's some use SMID, but there's little to no
I agree with
mid cap. There's massive platforms that everybody knows that don't have a single mid cap manager approved on their kind of SMA platform. It's nuts. And the issue is supply and demand have an impact on prices, right? So if everybody's investing in a small number of large cap companies, that's going to push valuations higher. If people are balancing that with small cap, that's going to push those valuations higher. And so you get this nice little sweet spot in mid cap where you get more attractive prices because that demand's not there, which means more attractive valuations, which means higher potential upside. And most importantly right now, in a time that I think most would say feels pretty uncertain, you get a margin of error or a margin of safety. The best way to sum that up is a risk return asymmetry, right? Like that's what we're all looking for our clients, is to take as little risk as possible to get as much return as possible. And by investing in places where other people haven't been chasing, and if you're going in places that you're not piling in after everybody else has, that's a good way to get that margin of safety. The other thing that I think is especially timely that many miss is one of the most interesting dynamics right now is interest rates. It seems like we're probably in stagflation, right? So inflation is still sticky, still a concern. Meanwhile, we're cutting rates because the labor market's struggling. And so let's say on both ends, interest rates go up and we don't end up in a recession. Let's just say interest rates go up. That's going to hurt small and, let's say, the lower mid-cap companies.
Yep.
The largest companies will probably be okay because they got good terms on their debt. But because we in particular are one at the higher end of, so upper, mid, lower, large, but in particular we're looking for companies with less debt, what we invest in should be less sensitive.
Yeah, good point.
But the flip side is everybody's I get that every time the Fed cuts, I think the first time, the stats I've seen are like 100% of the time the market's up in the short term. But if the Fed's cutting rates, they're cutting rates because they think we're in a recession, especially if we're in an inflationary environment. If we are or end up in a recession, that will not be good for small and mid, even though lower interest rates help them. But what that will really hurt is when markets go through a bear market, that's where things come back to reality. That's where the most overcrowded, craziest trades come back to their, and the problem is nobody's there slamming on the brakes at the mean. It goes flying right through, right? So it adds very significant downside risk. And that's where you could see the biggest names that everybody owns at valuations that are beyond the tech bubble decline a lot. And so, in spirit of the name of the podcast, I think a great way to build a better portfolio is partnering us. Actually, I'm going to back up for a second. I had a client of ours a few weeks ago say that he was pairing us with the Qs, which immediately might have given me hives. I don't know, but it definitely, I just explained that passive is just not it doesn't make sense to me. But his explanation was the market's a party. People are going pretty nuts right now. And his clients, their friends, their coworkers, their Uber drivers are all at the party.
Yep.
And they want to be partying. And if he tells them that they're not allowed to attend, he's going to get fired.
Yep.
So the Qs are a way to participate, sort of in a
keep his
they
job.
to keep his job, but they are the Qs are the life of the party, right? They're the ones at 5 a.m. that is ordering shots of tequila. Whereas, and then he was like, but you are our designated driver. You're at the party. We're at the party. We're long
That
only.
was still a good time, in case anybody's wondering.
We're still hanging out, but we're drinking club soda and at 4 a.m. And the Qs will keep it going, but then when everybody's ready to go home, we're there to get them home safe. And that was I love that as far as building a better portfolio. And I'll also add, one of the smartest people I know said the same thing, but this client said it differently, and it resonated with me. But to take it one step further for building better portfolios, the thing about passive is it's a momentum machine, right? It's a momentum construction. We won't say it's a strategy because it's not a strategy, but it's a momentum construction. The issue is it never sells, right? It holds things all the way up and then all the way back down. Whereas a momentum strategy is actually thoughtfully designed to be a momentum strategy, right? So if we're going to build a better portfolio, I really like the idea of pairing us with a large cap growth momentum strategy, and that'll balance really well with what we provide.
You're hired. You're on our marketing team now.
Love it.
Seth, that was awesome and a great analogy. One question we like to ask participants on our podcast or guests on our podcast is there somebody out there who has had a big impression on you or has really helped you in your career? We like being thoughtful and looking back to all the people that have helped us. We'd love to hear if there's somebody that really stands out to you.
There's two people that stand out for having made a significant impact on where I am today. The first is my freshman year high school English teacher, who happened to also, luckily, be my junior year English teacher. She was a special woman. I don't think you could get away with this today, but she walked in on the first day of school, freshman year of high school, and she wrote, hopefully I can say this, I guess you can bleep it out. She wrote really big on the chalkboard. And then she turned to us and she's like, that's me. This is the person in charge, and I own you for the rest of the year. And I was like, oh my God, this woman is amazing. But
Could not get away with that anymore, I don't think.
probably not. She was awesome. But so then I remember though, junior year, because I had her junior year, we had a book report. And the report that she put up on the projector, because that's what we had back then, was she was like, look, this person clearly didn't actually read the book, but it was the best written essay, so I can't just not put it up here. And just the fact that she was so comfortable and kind of flexible with not being angry about the fact that he didn't read the book. It was one of my closest friends. And he did that stuff all the time. It was very annoying. But she was amazing, right? And so when I look back, what led to me starting Running Oak, actually, I was a trader, and then technically that firm created a small hedge fund around what I was doing. At the best of times, I felt like I was playing a high-stakes video game. At the worst times, I sort of felt like a little bit of a parasite. And I had been married to my wife for a couple of years. Her mom is a teacher. We had just been through '08. And so hearing kind of about her mom, the fact that she was in Minnesota where they had labor unions, and so as a teacher, she was getting paid, let's say, $80,000 a year. It just became... It came to the top of my mind on a regular basis that this teacher that I loved so much, that had such a significant impact on my love of writing and everything, she probably made like $40,000 to $50,000 a year, right? And then you go through '08, '09, and you imagine their retirement. Not only are they getting nothing, their retirement just disappearing. So it was actually that idea, the idea of being able to hopefully provide value to teachers and pensions, was actually what led to me going down this route. Now that said, up until recently, we were too small to actually work with any pensions, and I don't think any teacher pensions are investing with us. So, I've still failed miserably as far as that goes, but hopefully someday. The other person I'll mention is, because it completely changed, it had a huge impact on my life from here on and the way that I'm approaching what I'm doing. I was a math tutor in college, and math always came just easy to me. I got in a lot of trouble in senior year in AP Calculus because I did pretty much everything in my head, and which annoyed my teacher to no end. And it just came easily to me, right? I could kind of visualize it. And then in college, I was tutoring for calculus, like 1, 2, and 3. And this woman comes in, and she was older. Like most people I'm working with are 18 to 22. This woman is upper 20s, lower 30s maybe. And she comes in for remedial math. I mean, it's the lowest. It was, what she asked for help for was basically creating a line chart, which I had done in, I don't know, 7th grade maybe. And it's one of those things that is so easy to take for granted that came easily. And it was such a significant realization for me to realize that people are built very differently. And it forced me to kind of attempt to put myself sort of in her position to try to understand where she's struggling, and to, get to a point where I could explain it to her. And she ended up coming in, and I worked with her for like 6 months, I think. But all that said, I think one of the real strengths that I can offer, or I can hopefully bring to the world, is taking fairly complex ideas and simplifying them. I feel like that's what I do best, really. And so it was all learning kind of from her. And my goal over the next, Paisley, you and I have talked about this a little bit, but I want to really make an effort to educate as many as possible on markets. I feel like so many people have been convinced that it's better to, again, not think. And the way in which the conclusion that they've been led to is to invest in passive. And again, passive is awesome in a lot of ways. It's cheaper. There's a lot of good things about it, and it's had a massive positive impact on our industry and just, investors in general. But I worry that especially right now, people are at the basically tip of a tsunami, and they have no idea that they're riding this huge wave. So I'm hoping I can help people get off the wave, thanks to working with that woman.
Yeah, no, I love that. I think I almost think about it as like the passive markets have allowed so many individuals to build wealth. And now thinking about this shift back towards active and being more thoughtful, and the education component, which is why we launched this podcast as well, allows you then to preserve that wealth and to think about drawdown and volatility. Because as you mentioned, passive just buys on the way up and then holds on the way down. So I love it. This was super great conversation. Thank you, Seth. Thank you, Josh. As always, happy to have you back anytime. And you mentioned earlier this new idea that you woke up with this morning and like wanting to create merch. Like his merch game is like A+. So if you guys have any ideas or thoughts, like Seth is looking for them. T-shirts, hats. I'm pushing on the sock idea. But thank you, Seth. Really appreciate your thoughts and insight, and best of luck to you and the company.
It was awesome. I love it. Thank you very much.
That wraps episode 6. Thanks, everyone. The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.